Bitcoin was flying high earlier this month, soaring past the $120,000 mark, its highest level ever recorded. Crypto influencers called it the golden season. Investors were bragging about massive profits, and social media was flooded with predictions of a $200,000 target before year-end. But this week, everything changed. Bitcoin took a sudden dive, wiping out nearly 15% of its value in just a few days. The once unstoppable rally came to a screeching halt, and the entire crypto community was left asking one question: what went wrong? To understand this fall, we have to look beyond the price charts and headlines. Because Bitcoin's drop wasn't random. It was triggered by a perfect storm of global politics, Wall Street expectations, and subtle blockchain signals that few people noticed in time. It all started with a wave of tension between the United States and China. Early in the week, news broke that the U.S. government was preparing a new round of tariffs aimed at Chinese technology exports, including components used in artificial intelligence and semiconductor manufacturing. In response, China hinted that it might restrict the export of rare earth materials, critical elements used to produce high-tech equipment. It was a political move, but the financial markets felt it instantly. Investors around the world hate uncertainty, and when two of the biggest economies in the world start a trade war, everyone gets nervous. Stocks fell, gold prices jumped, and Bitcoin, often seen as a risk asset during short-term panic, began to slide. You might think Bitcoin should rise when global chaos hits. After all, it's often called digital gold. But in moments like this, when traders fear big losses, they usually dump everything risky and run to safety. That's exactly what happened this week. Billions of dollars moved out of crypto and into the U.S. dollar and treasury bonds. Now, here's where it gets more interesting. Just before the fall, Bitcoin had been on an incredible high, fueled by the excitement around potential spot Bitcoin exchange-traded funds, or ETFs. For months, investors have been waiting for the U.S. Securities and Exchange Commission, the SEC, to approve applications from big financial giants like BlackRock, Fidelity, and VanEck. These ETFs would allow traditional investors to buy Bitcoin easily through their regular brokerage accounts, and the hope was that it would bring a wave of new money into the market. That optimism pushed prices to record highs in early October. But optimism can turn into disappointment overnight. Midweek, reports began circulating that the SEC might delay its decisions because of internal budget freezes and political pressure tied to the upcoming election season. Traders who had been betting on fast approval suddenly realized they might have to wait longer. In the crypto world, waiting usually means selling, and that's exactly what happened. Analysts even called it the ETF hangover, a market high that faded when reality kicked in. Many short-term traders had borrowed heavily to ride the rally, using leverage to multiply their potential gains. When prices started to dip, those positions were automatically liquidated, adding even more selling pressure. Within 48 hours, Bitcoin's price went from euphoric to fearful, a classic reminder that what goes up fast often comes down even faster. But the most fascinating part of the story isn't the headlines. It's what was happening behind the scenes on the blockchain itself. A few days before the crash, on-chain analysts noticed something unusual. Large Bitcoin wallets, mostly belonging to miners and long-term holders, were moving their coins to exchanges. That's a red flag. When Bitcoin is being moved from cold storage to trading platforms, it usually means one thing: those holders are preparing to sell. Data from analytics platform Glassnode showed that exchange inflows spiked by over 20%, the highest level since April. At the same time, the Bitcoin Fear and Greed Index, which measures investor sentiment, fell sharply from extreme greed to neutral. It was a quiet warning that big money was getting ready to take profits, while retail traders were still celebrating. And just like clockwork, the price followed. As the week went on, panic began to spread across social media. The hashtags #BitcoinCrash, #CryptoMarket, and #BuyTheDip quickly started trending. Everyone had an opinion. Some influencers blamed manipulation from Wall Street whales. Others said it was just a healthy correction before the next big run. Prominent Bitcoin supporter Michael Saylor tried to calm the storm, reminding investors that volatility is the price of freedom. On the other hand, longtime critic Peter Schiff wasted no time calling it another bubble burst. Every tweet, Every chart, every YouTube stream added more noise to the chaos. Meanwhile, average investors across the world, from Lagos to London, refreshed their apps, watching their portfolios shrink in real time. But here's the twist. Behind all that noise, the whales weren't moving. Blockchain data showed that the largest Bitcoin wallets, those holding tens of thousands of coins, stayed still. They weren't selling. They were watching. And that silence often speaks louder than any headline. So what does this all mean? Why did Bitcoin really fall this week? It wasn't one big event. It was a chain reaction. The renewed U.S. China trade tensions shook investor confidence. The ETF delays broke the excitement cycle. And the on-chain data confirmed that smart money had already started exiting before everyone else caught on. In simpler terms, the fundamentals of Bitcoin didn't suddenly change. There was no network hack, no technical flaw, no major scandal. It was just a market reacting to fear, the same human emotion that drives every boom and bust. Historically, every Bitcoin correction has followed a similar pattern: a hype wave, a pullback, and then a period of quiet accumulation before the next run-up. Some analysts even see this drop as healthy, a reset that clears out speculation and prepares the market for its next leg upward. Others warn that the global economic backdrop is too shaky for a quick rebound. With inflation pressures, trade wars, and political uncertainty rising, investors might stay cautious for longer this time. But if there's one thing Bitcoin has proven over the years, it's resilience. From government bans to exchange collapses, it has fallen and risen countless times. And each recovery has taken it to new highs that once seemed impossible. So maybe this fall isn't the end of a rally. Maybe it's the pause before the next chapter. Whatever happens next, one thing is clear. Bitcoin remains the most fascinating financial experiment of our time. It reacts not just to charts and numbers, but to human emotion, global politics, and technology's unpredictable rhythm. The next few weeks will reveal whether this was just another temporary dip or the start of a new market cycle. Either way, it's a reminder to every investor that in crypto, confidence is as valuable as currency itself. So what do you think? Is this Bitcoin's healthy correction or the start of a deeper slide? Let me know your thoughts in the comments. Thanks for watching. If you enjoy clear, fact-based stories that break down crypto trends without the hype, don't forget to like this video, subscribe to the channel, and hit the bell icon so you never miss what's really moving the markets. Until next time, stay curious, stay informed, and remember, volatility isn't always the enemy. Sometimes, it's just the market catching its breath.